everyone. Today we're sitting with Traci Thomas from Stratwell Advisory. Traci is somebody that I've worked with for many years. She's helped many of our clients to structure their property portfolios and with obviously their tax compliance in general. Traci, one of the questions I get asked a lot, especially for our up-and-coming property investors, our seasoned investors that are maybe a little bit concerned in terms of protection of their assets and obviously in terms of their, streamlining their tax going forward. They always ask us about the different structures, also in terms of flipping homes. What is the best vehicle to use for that? So I thought, you know what, instead of me always just passing them along to you, I thought it would be quite nice content for our audience to basically have something that they can kind of look at and then obviously contact you for a little bit more detail. So, Trace, if we have got a client that is looking for a 1 to 5 unit sort of investment property portfolio, then we've got the 5+ / commercial, and then we've got the ones that obviously feel the trust is like the holy grail. Can we kind of break it down for the newbie, the seasoned, the trust, and the pros and cons of each?
Okay.
And then anything else you want to sprinkle in the middle?
Okay, I'll do it.
Awesome.
So for a newbie, I suggest you're still trying to figure it out, deciding is this something that I'm going to go into? So you run it as a sole proprietor. That means the properties are in your name. The income will be taxed to your personal income tax return. Okay, but those assets are your assets. Okay, so it forms part of your statement of assets and liabilities, almost like your balance sheet. If you've got more than 5 units and you decide this is something I'm going to pursue now, I want an investment portfolio and I want to grow it, then it's a good idea to take those properties and to keep them in a company. So you can set up a company and you structure all your contracts and everything in the name of the company. So it's completely separate. Those properties are separate from your personal assets, and now you're going to be running an investment property company. Okay. If you want a commercial property, you can also put a commercial property into a company. It's not an issue. Yeah, that's fine. What I do suggest though is if the clients are going to do a mix of commercial and residential, I'd say keep the commercial in one company and keep the residential in a separate company. Okay, that's a good idea. If you're going to flip houses, the act of flipping a house means I'm going to buy a house, I'm going to fix it up, and I'm going to make a quick profit. So a quick profit, 6 months to 12 months before I've got money back in my pocket. You can do that in a company if you want, or you can do it in your personal hands. It just depends how many houses you're going to flip and what is the size of your stock going to be. And then you need to understand that the profit that you make there is taxed at your full tax rate. So it's not a capital gains tax transaction.
Okay, perfect. And then in terms of protection for a client, so the person is, has their day job and they have this other investment company. Is there any implications that we need to be wary of, how it affects, if something goes wrong either on their business side, their personal business, or their property investment side? Is there any liabilities, worries that we should kind of take into account?
So if the company's been set up correctly, if anything goes awry with his personal finances, say things go really bad, he has to be sequestrated. The company's assets are safe. Okay. In the company, if anything in the company goes wrong and he loses money and he has to sell the properties and go liquidate the company, his personal assets will be safe, provided that he's acted correctly in accordance with the law.
Okay. And what would be something to worry that he hadn't acted correctly in terms of the law?
So when you become a director of the company, so you own a company, you're a shareholder, and you're automatically a director because you're going to run that company, unless you hire someone else to be the director.
Okay.
There's responsibilities that you need to meet as a director.
Okay.
So you need to be sure that you're aware of what your responsibilities are, and then that you meet them.
Okay. Then in terms of trusts, so a lot of clients feel that, Tanya, I'm going to purchase my forever home in a trust because I want to kind of circumvent the whole estate planning thing that would move straight to my beneficiaries, which would be my children, let's say. But then come 5 years down the line, they now decide to sell this property. How does their tax kind of get affected in that sort of way?
Okay, so that's one of the worst transactions. So on your primary residence, you've got a 3 million rand exclusion on the profits.
On your capital gain.
Yeah, on the capital gain. Okay. In a trust, you don't have that, so you lose the 3 million exclusion. Okay, which can be very, very expensive. So if I bought property for 3 million, you guys sell it to me for 6 million, that 3 million gain that I've made on the property completely tax free, which is fantastic. I can put it in my pocket. If I had that property in the trust, I bought it for 3, or say the trust bought it for 3, you guys sell it for 6 for me, that 3 million gain is going to be taxed at 45%.
Which means they almost take half of our profits.
Take half of your profits. So
Something that we should kind of avoid.
your primary residence, I would never put it in the company and I wouldn't put it in the trust. There's no ways. Keep it in your personal name.
Okay, perfect. Then obviously with our Cape Town branch, we see quite a lot of clients looking for Airbnb sort of rentals, so the short-term rentals. Would that just apply as just additional income monthly? So as opposed to a long-term lease agreement, that would just, so your company that you formed, that you purchased this property in, all those monthly payments or weekly payments go into that company and then taxed accordingly. There's no other difference in terms of an Airbnb rental income.
No, there's no different tax treatment. It's exactly the same.
Okay, perfect. Traci, is there anything that you want to kind of bring to our attention? So in terms of legal deductions, so we have a portfolio of 10 units, what can we and what can't we claim against our income, you know, when we do our tax return for the company?
So the first thing that I tell my clients is you need to think, what did I do, what did I incur, what did I spend in order to make my rental income?
Okay.
So what happened? Got your rates and taxes, electricity, your water, repairs and maintenance, levies, you've got the interest paid on your bond, I'll come back to that later. Anything, commission on the property, if there was a consulting fee, consulting fee that you had to pay, anything, okay, that meant that you could make income out of that property. So if you are spending 3 hours a day on your cell phone, or you're spending time on your cell phone, you can claim a portion of your cell phone bill against that rental income because you're using it for business purposes. If you have to meet with a potential tenant, okay, and you need to meet, say you meet at a coffee shop and you have a discussion, you can claim the bill at the coffee shop. If it's more formal and they want a meeting room, the same thing, you can claim the meeting room.
Okay. Then in terms of going back to the interest portion on the bond, so it's not the full bond amount, it's only the interest portion. Okay. Okay. So Trace, let's use hypothetically, we've got a client that has got a beautiful family home, maybe on the coast, let's use that as an example, and now they want to transfer it from their personal name into a company. Is there any associated costs or is it straight out transfer duty applicable on that amount? Let's say we wanted to transfer it for 2.5 million rand, just hypothetically. How would we go about that and are there associated costs in doing that?
Okay, so it depends how you're going to do the transaction. Okay, so the first option that they've got is they can sell the property out of their personal name into the company.
Okay.
Then you've got the property in the company, but now the company owes them the money. Okay?
Okay.
So there has to be some kind of repayment there.
Like a loan agreement?
Yes, how are we going to do that? Okay, so that's one option.
And the property would have to be paid off, not bonded at that point?
The property has to be paid off and not bonded. If it is bonded, then they need to contact the bank and there will be a new contract that will be drawn up. And then there's costs relating to that. If the bank will be willing to move and renegotiate, sometimes the bank doesn't want to.
Okay.
A second option you've got is called a Section 42 transfer. So it's an asset or share transaction. So what you do is you take the house and you're going to sell the house to the company in exchange for shares. So instead of there being a loan account and the company owes you that money, you say the house is worth, say, 2.5 million. I'm going to give you X amount of shares. Those shares are worth 2.5 million.
Oh wow.
That is a lovely transaction. And with that transaction, there's no capital gains tax, because there's rollover relief in the Income Tax Act for it. There's no transfer duty on it.
Oh wow.
So you've got a rollover relief there as well. But the Section 42 transaction needs to be structured correctly.
Okay.
With the first option, if you just sell the property into the company, you've already triggered capital gains tax. So then you've got capital gains tax in your personal name.
Okay. So guys, don't try things at home. Make sure you see a professional. These kind of things are not to be played with. We know our friend SARS does their jobs very diligently. So yeah, Traci, I'm sure you're going to be getting lots of Section 40. Is it Section 42?
Section 42.
Well,
Yeah.
Section 42 calls. I have no doubt about it. Traci, is there anything else you want to bring to our attention, that we want to be good South Africans that are running our taxes accordingly, but also paying as little as possible? So if you can give us anything that we've missed now, we'd really appreciate it.
What I really want to tell you guys is everything that you spend, every expense that you incur, whether it's in your personal name or in the business, make sure that you've got an invoice for it and that you've got proof of payment. So a lot of the orders that I'm getting now on the rental properties is we'll send in the rental income statement, so it'll have your rental income and then all the deductions that we spoke about earlier, and SARS will come back and they'll say to us, I want all the invoices and all the proof of payments. And if you aren't able to give them that, then they adjust your assessment. If they're really difficult, they add all the expenditure back and they tax you only on the income. And then you're into the objection phase.
Which is not fun.
No, it isn't fun, and also it's stressful, which you find you want to make. So, first prize, keep all your invoices, make sure you got your proof of payment, your bank statement will suffice as proof of payment. If you pay cash for it, you can write on there that you pay cash for it. You know, if it's a small amount, for example, something from a board,
Locks.
whatever exactly. But just keep all of those invoices and keep them filed safely so you can get hold of them quickly.
Okay. And I believe there's a new scanning app for invoices. Apparently, somebody told me, one of my clients said that you download this app and they actually scan it for you, or you scan it, and then it sends it straight to your accountant.
Oh, there's plenty.
Oh, really?
There's plenty. We use the Xero platform.
Okay.
So you can do it through Xero itself. Where if you've got a bill, you just take a photo of it, it'll automatically pop up on our side and we can allocate it. So yeah, that's pretty cool. Or you can just email it directly into the system.
Oh, wow.
And the nice thing is it's there, so if you need it,
It's easy to reference.
Easy to reference. Yeah. But there are other apps that will plug into the accounting platform that you use.
Okay.
It's very cool.
Cool. Okay. Awesome. Well, guys, I'm sure we're going to be leaning on Traci a lot going forward. I hear that every year our taxes, this year was actually a very nice budget speech.
Yeah, for a change.
For a change, 100%.
They increased the limits. Can you believe it? Exclusions went up. It was great.
So it was a good one. So hopefully on our next one, we'll be back and we can see what else we can save money on.
Yeah.
Thanks, guys.